Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. If you haven't heard from us in a while at Trading University, that's because we've been on summer break. We tend to take a pretty long summer break in August. We actually took it a bit early this year, starting in July. I thought it's an appropriate time to check in now, given you've seen some pretty big moves in the markets. Let's get right to the markets. The Australian dollar is one we cover first. Not a lot has happened here. The markets found support just above 90 here. We had that support at 91, and typical of a movement with good momentum down. It overran that border, but you're starting to see the market stabilize. I think we need to pan out for the weekly to really give you scope here, to give you scale. And here's the big picture, long term. You could see that we have the primary pattern up still, that long-term grand pattern. Everything else is down, though. Your primary's down, your secondary's down, that day-to-day, which is our 50-day pattern, all down. That big grand pattern's still up. Longer term here, I think if you're going to stick your nose out and buy this market above 90, you have to realize that's either a real short-term play or you're going to start to go in small with the thinking that you're potentially going to add to that investment on a further dip. I like buying dips all the way down here, below the 85 handle, in that buy zone. See the buy zone created by the purple line and the green line? I think long term, that's where potentially this market goes to. So I think if you're looking at the 90 area as an investment, you better be going in small with the idea that you can add to it if it goes lower. That's just my thinking. You pan out or scroll down to a 4-hour chart, and you can see some pretty good trading opportunities both sides here. We would primarily continue to focus on the short side for trading opportunities, given the obvious pattern of lower highs and lower lows. So the Aussie, not a lot has changed. What I think is telling about the Aussie is that you had this pretty big short covering rally. You had a pretty good counter trend correction in the euro, but you barely had a hiccup in the Aussie. So to me, that's telling me the Aussie's still weak. There's still pretty good underlying weakness. And, the story of weakness in the Aussie, panning back out to the weekly, I think this is the commodity slowdown, but it's Chinese slowdown too. Long term, China's completed so many of these projects that it had on the board, and that doesn't necessarily mean that you see an overall slowdown in China. They still have the great project of now moving the people from the country into those cities they've built. As far as building materials, though, on the commodity side, I think that boom's over, and that's why you're seeing weakness in the Aussie, and I don't necessarily see that coming back anytime soon. So I think from a longer term fundamental standpoint, the chart here is reflecting that, and that's why you see that strong momentum down here, your momentum indicator down here at the bottom of the chart. So I think long term you still have some more downside. That's just my thinking. And speaking of commodities, the Australian dollar being a commodity currency, and I probably hadn't put enough emphasis on that the last year or so because we looked at it as really a financial product with that big yield. Keep in mind, it still has that pretty good yield relative to the other currencies. That's why I think long term, I see it as an attractive investment. Not necessarily here just yet, though. I think you get closer to 85, and that would be an area where you start to layer in. And again, always with longer term perspective, with the ability to add if it goes lower against you. View it from an investment standpoint. But on the commodity side, here's copper, which is a huge building product, and you had huge Chinese demand for copper. Let's look at a monthly chart for scale. If I'm in the copper mining business, or I'm advising copper miners, I would be telling them you better be 100% hedged. I think this is a time where you're 100% hedged, meaning all your production, however much copper you have that's scheduled to come out of the ground in the next year, I would have a short position in the futures to hedge that. Why? Because I think potentially you see lower prices. To me, the chart's a reflection of the underlying fundamentals. Look at the momentum down in this market. This could be a serious occurrence for a copper mine. they're not hedged, and they have their production costs are still going to be the same. If anything, the production costs are really lingering higher because of higher oil prices overall. That puts a copper mine in a bit of trouble. You have to pay your workers the same. You have to pay the energy costs are the same, but you're not getting as much for that product, so you're really getting squeezed there. So put it this way, as I said, if I'm advising copper industry, I'd be saying, hey, I think you need to hedge as much as you can. You need to be hedged up here for lower prices. This is a pretty ominous chart. Let's go to the next commodity, and we're looking at corn. And corn's an interesting one, because as we used to say on the floor of the Board of Trade, people need to eat, right? So I'm not that bullish on a building product. It could be a long time before you get back to the demand that we saw in building products such as copper. Corn's a little bit different. It's a feed product. You're having a great year for growing corn in the United States. Here's my thinking on corn. What was the old high back in the 80s and 90s, and even in the first half of the 2000 decade? $4 corn was pretty expensive. I think we could see that $4 corn, the old ceiling, becomes potentially the new floor. From a longer term perspective, I think $4 would be an interesting area in the corn again, and I think if you get down there, potentially you start looking at the exchange traded fund corn as far as the longer term investment. But again, I think you go in slow, and you take into account that it could continue to roll lower to even beyond 4. Yeah, we're having a great crop in the U.S. Most of your fields you're looking at 8-foot tall corn plants already. The corn just tasseled, so you're starting to see the ears come in. The corn itself is growing, so there's plenty of corn out there. So I think over the near term you could see lower term prices, but this is one where I think you can buy the dip, and I think as an investor you have to look at corn starting around that $4 area. I look at corn is if you get a shot at 4, I think you have to start nibbling with that exchange traded fund, put it in your longer term investments, and it's one where you start to nibble, but you hope it does go lower so you can dollar cost average it down. You could see that $2 corn, I don't know if we'll ever see that again. But you could see just looking at this historic chart that if you get corn down somewhere towards the bottom of that chart, you have to take a pretty good look at it, right? So corn is one I like from a longer term perspective. Copper, not necessarily. I just don't see the demand for building products, but people need to eat, right, like corn. Getting back to the currencies, the euro has really been a heck of a distraction, and we'll scroll down to a daily chart, and here's how we view this market. You still have the majority patterns down. The euro has a rich and well-deserved reputation for short covering rallies and really just picking the pockets of the speculators that try to short this market. From our perspective, the majority patterns are still down. Here, if we look at our ratio, and if you want to know more about this, we'll tell you a little bit about it in a moment. But the majority patterns are still down. So the euro, from our perspective, still pretty bearish despite these rallies. You had this one big rally when Chairman Bernanke spoke here, and price is still inside that range. So you've been inside that range for a long time now. We see this as a correction. In fact, our 50-day pattern is still down. As long as you're below 132, this pattern's bearish. This overall pattern down is still in control. So for our money, the 50 days down, that's a good one to go with. From my perspective, I like the idea of getting short maybe just below 32 even with a tight stop just above it. If it knocks me out, then I wait for 134 again. Really, it's identical back to here when the same story here. You get short somewhere around 32 with the stop a little bit above there. You catch the ride down. If it blows through 32 like it did here, you set up again at 34. But you have to trade small if you're selling a rally. Then if it does turn, such as it did here, then you can, well, I should say here, when it turned there, then you can add to the position. So you go in very small with a stop. If it turns, then you can add to that position on the turn. Or that's how I'd like to sell a rally. On the other hand, if price closes below that yellow line, which is my daily directional line, if you close below the low of the highest closing candle, then I become more aggressive. I would add the shorts there or initiate shorts on that too. So that's how I look at the euro. But if we pan out to a weekly chart, you can see essentially you're in a sideways range right here overall. But we're still bearish on this market. We think that the Bernanke rally there, based on those FOMC minutes and then Bernanke speaking later on that evening, we think that's corrective, and that overall we're dollar bulls and therefore euro bears. Next market, dollar yen. We love dollar yen. You know, I've said this all along in all our webinars too. Anytime you have the day-to-day aligned with either the secondary or the primary, you have to work the long side there. In this case, you have them all aligned. You have the day-to-day up, the secondary up, the primary up. So this is a bullish market, dollar yen. So we think there's still going to be more upside here. We think 106 or so would be our upside target, and it tends to overshoot that. So that's our perspective on the dollar yen. Let me tell you this though about having an overall target, especially from a trader's perspective. This is a great quote I came across and I love it. Old Buddhist saying, "With one eye on the destination, there is only one eye left to find the way." You can't get married to where you think a market's going to go to. You have to keep both eyes open as a trader, and this is particularly true in the euro. Remember, you can have an opinion, you can be positioned short if that's what prices and pattern is telling you to do, but if something changes, you've got to change with it. You've got to get out of the way. A euro rally here, a big euro rally here, could be the best thing in the world for us long term to reset positions and get in at a more advantageous level. Then when it does turn, we're able to add to that position. So old Booz is saying, keep this in mind, more so for a trader for sure than an investor. One last chart, we're going to look at the U.S. stock market. U.S. stock market pretty tough. You can see when it overcame the RTT level right there, when it closed above it and it closed above that trend line, that really opened the door to the upside. No surprise. Generally you get a bit of a bearish seasonal, and we've talked about that too, but you're not seeing it this year. So, I wouldn't be crazy about adding longs at this position. You just made a new high here. At the same time, you certainly can't be short this market. I did notice, even though we're on summer vacation right now, that you had what could be construed as a bearish retail sales number. I took a look at that before I came on with you today, and here's a chart of the U.S. retail sales. We got this from ycharts.com. This is a one-year chart. Retail sales were essentially unchanged, so it hits the tape. Retail sales in the United States unchanged. Well, that is true, but they were unchanged from the month before, where you had pretty good retail sales the month before. So, is the U.S. economy slowing? Well, not yet. Okay, so you could see if it holds that trend, you could even have a correction. You could lose a few points, and overall, U.S. retail sales are still in pretty good shape. They're still following that trend. So keep that in mind. We think overall that's long-term dollar bullish, and we're still bulls on the U.S. dollar. You saw a pretty good backup in the U.S. dollar based on that rally in the euro itself. The euro is actually 60% of the dollar index. Hey, thank you so much. We'll be back towards the end of August for Trading You, and we look forward to seeing you guys coming into some of our live classes to demo them also. If you want to find out a little bit more about how we analyze markets, here's our book, The Secret to Trading Forex Futures and ETFs, Risk Tolerance Threshold Theory. That's the best $6 you could spend if you want to know about trading, and that book's on Amazon, and we'll put the link for it just below today's video. Good to catch up. Thank you guys so much, and we'll definitely see you again. And enjoy your summer.